and welcome to Auditing and Assurances Services, where we are going to cover today completing the audit. And as Yogi Berra, a former American Major League Baseball catcher, coach, and manager said, it ain't over till it's over. In this chapter, the learning objectives that we are going to cover include identifying the major activities performed by auditors in completing the substantive procedures following the date of the financial statements. Additionally, we're going to understand the role of the attorney letters when we as external auditors are evaluating litigation, claims, and assessments. We're going to explain why auditors obtain the written representations and the key components of those written representations. We're going to identify the final steps that we need to conduct in order to complete an audit and understand the auditor's responsibility for subsequent events and subsequently discovered facts. Lastly, we're going to identify the important activities and communications following the completion of the audit and up until the audit report release date. So when we look at an audit timeline, we start at the beginning of the year, which is, let's just assume it's a calendar year. So January 1st, we might do some interim testing, some test of controls, some substantive procedures. Then at the year-end date or the date of the financial statements, again, December 31st, we're going to complete those substantive procedures, the attorney's letters. We're going to get written representations, anything about going concern assessments. We might be proposing adjusting journal entries and making sure that our audit documentation is intact, including those subsequent events. Then the date of the auditor's report, let's assume it's February 15th, 2024. Any subsequently discovered facts we would note. And then lastly, a couple of days later on February 17th, 2024, our audit report release date, we would actually note any subsequently discovered facts, any omitted audit procedures. We'll get our management letter communications with those charged with the governance. So the procedures that we perform during field work, as you are probably familiar, are the substantive procedures. We're going to look for attorney's letters, get our written representations, look at our going concern assessment, propose our audit adjusting journal entries, review our audit documentation, look for subsequent events, and then decide what we're going to do when we have subsequently discovered facts. Then we're going to have some roll forward procedures where we're going to extend the work that we did at an interim period to the date of the financial statements. This could be test of controls. This could also include all forms of substantive procedures. We are going to do all of this from the date of the financial statements, and the idea here is to obtain evidence, again, that is sufficient and appropriate to support our audit opinion through the date of the financial statements. So when we're looking at analytical procedures, we're really looking at the study of relationships among both financial and non-financial data. So we use this typically in planning, which is required, and then we also use analytical procedures as part of our substantive testing, and then we also complete analytical procedures again at the end of our audit because that is required. And towards the end of the audit, these analytical procedures will hopefully help us identify any unusual or unexpected relationships that we may have not identified during the planning stage. So we're going to review accounts that might say other or clearing or suspense accounts or miscellaneous, because all of these accounts might relate to earnings management. Then we're also going to take a look at accounting estimates. This could be future cash flows when we're looking at evaluating asset impairments. This could also be the allowance for doubtful accounts for the accounts receivables or the depreciable lives for fixed assets. We want to review management's process for determining these estimates and make sure that it is reasonable. Then we're going to look at our procedures for litigation, claims, and assessments. Obviously, we're going to inquire of the client. We might look at the minutes of meetings of not only the stockholders, but the directors and other committees. We want to look at contracts, loan agreements, any type of correspondence between governmental or tax agencies. We want to get all of this information that concerns any guarantees that we have from bank confirmations. We want to look at any legal services and attorney's letters to see what we have to do as external auditors. So what happens here, as you can see, is we start with process one, which is the auditor is going to request the client to prepare the attorney letter. Then as the external auditors, we're going to send the attorney this letter, and then the attorney will respond to us, the external auditors, with their response to our attorney letter. So here as auditors, we are required to inquire of the client regarding the existence of any litigation, claims, or assessment. And as external auditors, we need to perform procedures that are regarding these litigation, claims, and assessments. So we need to initiate the request to the client for the attorney letter, and then we need to mail the attorney that letter. And nowadays, we're doing that electronically. The client definitely has to respond to us, the external auditors, regarding these litigations, claims, and assessments. And then the client provides the external auditors via a PBC provided by client a list, a description, and a potential evaluation of these litigation, claims, and assessment. The client prepares the letter to the attorney, and then the attorney hopefully responds to this letter, and they respond directly to the external auditors. So then as an external auditor, we would look for written representations, right? So this is provided by management to the external auditors. And it is dated using the date of the auditor's report or the auditor's completion date. And basically this written representation is basically telling us that management is primarily responsible for the financial statements, and it establishes to the external auditors the defense if a question related to the inquiries subsequently arises. So if as an external auditor, we qualify or disclaim the opinion, then this written representation is obviously not provided. And what do we include in this written representation? So here we say that management is responsible for the financial statements and the internal controls over financial reporting. We also state that the appropriate disclosures, presentation, and reasonableness of items are there, and that any uncorrected misstatements are immaterial. And this information is provided to the external auditors by management. And if it is a publicly traded company, management also has to state that they have an understanding of the internal controls over financial reporting as well. So additionally, as auditors, we are required to consider whether there is evidence that is obtained during the audit that could potentially raise questions about the ability to continue as a going concern. If this going concern exists, as auditors, we need to evaluate management's plans to mitigate that. So if the concerns don't remain, then obviously there's no effect on the report of the financial statements. But if there isn't a going concern that does remain, then as external auditors, we need to ensure the proper use of going concern basis of accounting, and we would possibly have to modify the auditor's report and opinion. Then when we're looking at adjusting entries and financial statement disclosures, we need to accumulate dollar effects of any identified misstatement. And when we're doing this, we're trying to evaluate materiality. So when we conduct the rollover method, we're considering the current period income effects of those misstatements. So we have the Iron Curtain method that considers the aggregate effect of these adjustments on the entire entity's balance sheet. And SAB 108 requires adjustments to be proposed if material under either one of these two approaches. So the recommended adjustments of all misstatements is identified, and then we carry any of these uncorrected misstatements forward so we can consider them in future audits. And we, as external auditors, have to communicate all of these adjustments and misstatements to the audit committee or the individuals that are charged with the corporate governance. And now when we're looking at our audit documentation and reviewing them, the audit supervisors, have they completed all of the steps in the audit plan? Is their reference among the documentations clear? Are the explanations understandable? Then in the role of the audit manager and partner, is the overall scope of the audit adequate? Do the conclusions support the audit opinion that was rendered? And then in the role of the reviewing partner, is the quality of the audit work and reporting consistent with the quality standards of the firm? And then the reviewing partner would conduct an engagement quality review on all of the audit documentation. So now when we're thinking of the timeline for subsequent events and any subsequently discovered facts, right? So we've reviewed this originally, and now we have our original chart where we were doing at the beginning of the year some interim testing. Towards year end, we were completing those substantive procedures and looking at any subsequent events. And then at the date of our auditor's report, we were looking at any subsequently discovered facts. And then lastly, a few days later, when we released the audit report, we were looking for any omitted audit procedures, the management letter, and any communication with governance. So if we have to conduct procedures to identify subsequent events. And in order to do that, we need to obtain an understanding of the procedures that management performs in order to identify these subsequent events. So as external auditors, we would inquire of management and those that are charged with governance. We would read minutes of any meetings of the owners, management, or any governance meetings. And we would obviously review the entity's interim financial statements. And we are looking for certain types of subsequent events. So this would provide any new information about conditions that exist at the date of the financial statements. And then we're going to adjust the financial statements to reflect this new information. If these events that are involved after the date of the financial statements, then we do have to disclose those in the financial statements. Then when we have subsequently discovered facts. So if we discover anything prior to the audit report release date, then we have to perform procedures that relate to this subsequent fact. So we might have to revise the date of the auditor's report to reflect this new completion date, or we might have a dual dated auditor's report. And then if we have the following, that if one of these subsequently discovered facts happens following the audit report release date, if these facts would result in a revision or of the auditor's report, or if the financial statements and the individuals that are relying on these financial statements, then we need to notify those individuals that are relying on the financial statements and then issue a revised financial statement, which actually provides that disclosure of this subsequently discovered fact. So then we have the procedures that we have to follow after the audit report release date. So if there's any omitted procedures, we do have to communicate with those that have a governance charge, and we also have to obtain the management letters. And then if we have omitted procedures, so we perform procedures if these omitted procedures aren't important and individuals that are currently relying on the financial statements and auditor reports. But if the previous opinion can be supported, then we don't need to do anything further. But if the previous opinion cannot be supported, then what we have to do is withdraw the original report, issue revised reports, and then inform those individuals that are currently relying on the financial statements. Then we have communications with those individuals that have a governance charge or internal controls. So we understand that the professional standards require auditors to communicate these significant internal control deficiencies and material weaknesses to client and those charged with governance in writing. So for public companies, this communication has to be made prior to the audit report date. If it is a non-public company, then the communication has to be made no later than 60 days following the audit report release date. And then we have communications with other individuals that might be charged with governance. So our responsibility under generally accepted auditing standards, we need to make sure that we have an overview of the planned scope and timing of the audit, the judgment about quality of accounting procedures, estimates, and disclosures, any significant difficulties that we might have encountered during the audit, any uncorrected misstatements or any disagreements with management. If there are material corrected misstatements, we need to disclose those. We also need to note the representations that were requested from management and management consultations with any other auditors, any significant issues that we as auditors discussed with management, and then our auditor's understanding of significant unusual transaction and any other findings or issues that possibly could be significant and relevant that we would want to communicate those to those charged with governance. Then we move on to the management letters. Now, this is not required by generally accepted auditing standards, but it is prepared as a byproduct of those procedures that we perform during an audit. And it basically gives the client recommendations for improving their effectiveness and their efficiency of operations. And so this is given to the client by the auditors, and it's usually right after the audit engagement, sometimes referred to as the Blue Book. And it's our value-added services as auditors. So here is the summary of all of the audit communications that we need to do, whether it is an engagement letter, the acceptance letter, the attorney letters, and those written representations, any deficiencies that we found within internal controls, and any communications that we need to do with those individuals that are charged with governance, and then lastly, the management letter. And if any of these communications is done orally, we need to document it, but the recommendation, as you will see in all of those references pretty much, is written. And that is where we tend to do all of them, written, not oral.